Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning and welcome to the final day of the month, Wednesday the 31st of May. This is Peter Lewis with Hong Kong's top-rated business show, the original Money Talk. Accept no imitations. You can find us on Apple Podcasts, Google Podcasts and Spotify. Just look for Peter Lewis's Money Talk in your favourite podcast app. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, concerns are mounting over whether US lawmakers will be able to pass the debt ceiling bill ahead of the looming June the 5th deadline, with Republican opposition to the bill mounting. A group of Republicans, led by Pennsylvania Congressman Scott Perry, said on Tuesday they would do everything in their power to block the deal. The compromise bill to raise the debt ceiling faces its first major test in the 13-member House Rules Committee later today. Two of the panel's 9 Republicans have signalled they will oppose bringing it to the House floor for a vote. China called for stable and constructive ties with the US in a meeting with Elon Musk Tuesday. Mr. Musk arrived in Beijing for his first visit since the outbreak of the coronavirus pandemic and met with Chinese Foreign Minister Qin Gang. Mr. Qin said China will continue to promote a high level of opening up to the outside world. Some experts expressed concern Tuesday about the rise of artificial intelligence. A group of scientists warned that the new technology was so powerful that mitigating the risk of extinction from AI should be a global priority, alongside other societal scale risks such as pandemics and nuclear war. The warning came in a one-sentence statement published by the Center for AI Safety, which is a San Francisco-based non-profit organisation. More than 350 AI executives, researchers and engineers signed the statement. On today's programme, I'm joined by our regular Wednesday commentator, Enzio von Pfeil, who is also a capital preservation specialist for individuals. Also with us is Hao Hong, chief economist at Grow Investment Group, along with David Roche, president and global strategist at Independent Strategy. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks faltered Tuesday in a choppy session with strength in the technology sector, offsetting losses elsewhere on uncertainty about whether lawmakers would pass the debt ceiling bill ahead of the looming June the 5th deadline. The S&P 500, which ended last week at a 9-month high, was flat on Tuesday at 4,206. The Dow lost 51 points, or 0.2%, to end at 33,043. The Nasdaq Composite Index is off to its best start to a year in more than 30 years. It added 0.3% to finish at 13,017, pairing gains after trading up as much as 1.4% earlier in the day. The Nasdaq was boosted by a surge in AI stocks. The gains were led by shares in computer chip designer Nvidia, which closed 3% higher after jumping 24% last week. And that takes its gain so far in 2023 to more than 180%. At one stage in the session, the company's valuation exceeded the $1 trillion mark, making it the first $1 trillion chip company, joining an elite group of US stocks that includes Apple, Microsoft, Amazon and Google's parent Alphabet. Some profit-taking later in the day left Nvidia with a market capitalization of $992 billion. The surge in Nvidia's market value has come after the company projected its sales would rise to $11 billion in the 3 months ending in July, exceeding Wall Street's previous forecasts by more than 50%, aided by a surge in demand for AI chips. Morgan Stanley described Nvidia's outlook upgrade last week as the largest dollar revenue upside in industry history, and they added, "We simply have no historical precedent for the magnitude of this step function." By contrast, Hong Kong stocks hit a new 2023 low in yesterday morning's session. The Hang Seng Index fell 1% at the low of the day, before rebounding to close 45 points, or 0.2% higher, at 18,596. That's close, though, to a 6-month low, and the Hang Seng is down 18% from its January peak. The pain is set to continue for Hong Kong stocks this morning. Futures markets are indicating a decline of around 230 points. That's 1.3% at the open. The Hang Seng China Enterprises Index snapped 4 days of losses, rallying 0.5% after slipping into a bear market earlier in the day, defined as a fall of 20% from its recent peak. Mainland markets were also higher in choppy trading. The CSI 300 index of the largest listed stocks in Shanghai and Shenzhen rose 0.1%, having erased all of its 2023 gains last week, and it's heading for a fourth straight losing month. The benchmark has tumbled almost 9% from its peak at the end of January, wiping out $1 trillion in value from domestic A shares. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Wednesday morning guests. We have with us our regular commentator, Enzio Pfeil, who is a capital preservation specialist for individuals. Good morning, Enzio.
Good morning, Peter.
And also with us is Hao Hong, who is chief economist at Grow Investment Group. Morning to you, Hao.
Good morning, Peter.
And welcome back to David Roche, president and global strategist at Independent Strategy. Nice to see you and hear you again, David.
Hello, everybody. It's nice to be back.
Let's start with the economic data that we've got coming out from China later this morning. China's going to release official Purchasing Managers Index data, followed tomorrow by the private sector Caixin Manufacturing PMI. The contraction in the manufacturing sector is expected to moderate slightly, according to a poll of economists, while the rate of expansion in the stronger services sector is expected to slow. Enzio, let me get your thoughts first of all. What should we be looking out for from these numbers this morning, and what are you expecting?
Well, I don't really do the sort of month-to-month forecasting. As a general point, I think that when markets in January were very buoyant about this recovery, we were a little bit conservative and warned that it was not going to all be tickety-boo. At the same time, we don't think that China is dead. I think that the key issue that we have in China, just to sort of cut to the chase, is actually the zoological outlook of the three rhinos, being the demographic time bomb, the mountains of death, and the decoupling. And these things aren't going away, and if they don't go away, it could become a mini Japan. The key to this really is that China needs to get going again. It does, after all, account for 50% of tax revenue, 60% of GDP, and 80% of urban, and allow the private sector to flourish yet again, as they did in previous regimes. I think it's going to be a very slow upward trajectory.
And these three Chinese rhinos, these are things that basically are the big risks, aren't they, on the horizon that policymakers need to be looking out for? Quite.
The debt situation is not just a federal debt in American terms, but also that of the local governments, as we all know. The demographic time really here list knows about that, and the decoupling we all know about. These are all threats to the Chinese economy. As long as they go with the flow, the old Americanism, if you don't like change, you would like irrelevance even less. Well, the Chinese are actually pretty pragmatic people, so I've got every hope that they will go back to the markets and allow the practice of fish, but that'd be the sine qua non.
How investors seem to be quite disappointed with the economic recovery at the moment in the mainland. Why is China's recovery stuttering?
Yeah, well, I think, the reasons run deeper than that. I think, in the past 3 years, what you're seeing is that the Chinese exports has been particularly strong, and export is the sector that is holding up the economy, and export is the sector that is satisfying foreign demand. So I think, in a way, when you see record trade surplus and also record deposits in the Chinese banking system, it's symbolizing that, China is sucking industrial growth out of the Western countries. But then at the same time, because of the lockdown and pandemic control, consumption becomes very weak. And now, going 5-6 months after reopening, we're still seeing youth unemployment at more than 20% at all-time high, and also people's incomes are not growing as much. So even though we have a very strong first quarter rebound, and I think second quarter, we should expect some reasonable year-on-year growth as well because of very low base last year. The fact is that, export sector is slowing because of the foreign demand is being tempered by the Fed. And also the Chinese consumption is still struggling because of income and unemployment. Right? So I think that is the situation right now we're facing. And I think that is why the recovery seems to be sputtering after 3-4 months of going into this year.
So presumably export growth on its own, while obviously we're pleased to see that, that's not going to be enough to hold up the Chinese economy.
That is because the foreign demand is subsiding as well. Because if you see the inflation pressure in the U.S. economy, that is subsiding. So that's meaning that the U.S. demand is weakening because of the Fed tightening.
Okay. David, are you disappointed with the performance of the economy? Do you think it should have been doing better?
No. I think China's coming down to a growth rate which reflects the structural nature of the rhinoceros. In other words, clearly the leverage problem has not been resolved, but actually hasn't been resolved in housing. But the most immediate one is local government finances, where probably around between 20 and 60% of these entities do not cover their interest payments, but they do account for 8% of bank lending. So you've got that. You've got the fact that the consumer no longer has confidence, really. Is certainly not rushing out to spend the excess savings that it built up pretty well without government help, by the way, in contrast to the US or Europe during the pandemic. So you don't have the consumer going wild about opening up either. They're being very cautious. The young people are doing badly, and they're going to go on, I think, saving a large proportion of their income for rainier days. So in my view, the most important thing, however, was what I was saying, and that is the structural nature of the change of international trade. China can't use export demand anymore, really, to boost its economy, because the world is split into alliances, which China, Russia are one, Western all democracies, nearly, except for this so-called global South, are on the other, and they're not going to trade with each other like in the days of globalization. That's over.
So is the priority for the consumer then now, rather than spending, to build up savings even more, or use those savings maybe to pay off existing debt?
Well, look, if you look at the pattern of what happens in economies when they open up, you get this bounce everywhere. And then eventually you settle down to what the economy is actually capable of supporting. Now, the difference between China and the Western world was that the fiscal spending, the fiscal transfers were actually towards corporates and much less towards the individual. So the excess savings phenomenon in China was always much less of a buffer to be spent when people felt better than in the United States or in Europe. So essentially, you have a different consumer behavior, which is, do we feel good enough about things in order to go out and spend money? There are excess savings, but they certainly weren't boosted much by the government. And the answer is that, I think it was Howe mentioned youth unemployment. With that at 20%, these young consumers are not going to go wild. So you don't have the same even domestic demand support, which you had in the Western economies, and even Japan, as you can see, as they came out of COVID.
Enzio, you also mentioned the debt as well, the national and local debt level. We heard this story earlier in the week about Wuhan in the centre of China naming and shaming debtors in the local newspaper, which tends to suggest that this is becoming quite a big problem for some of the local sort of municipalities.
I think, again, just broadly speaking, that they've as David was saying, they've overextended themselves. I just wanted to add one point to the trade discussion that we've had. Let's also not forget that what I've in my book on trade myths called the host country protectionism. In other words, the Chinese government also, quite understandably, beginning to possibly turn on the foreign entities working in China itself, and they must again account for quite a bit of technological progress, R&D, employment, and all that. So if they also turn on the foreign multinationals in China, then I think the slowdown is going to become exacerbated. So I think you've got that double sort of whammy there of the local government debt rising ever more, and really just coming to light now. It's been going on for years and years, as we all know, but then also this turning on the foreign subsidiaries.
I
think that's a very good point.
Yeah.
Very good point.
Can I just add that, the Wuhan government is just trying to, put the blame on the companies, especially the SOEs, that is not, repaying them back. Obviously, there's a delay in the cash cycle and also, some sort of cash flow problem. But I think the Wuhan government make it public, just to make sure that, he's not taking the blame, of what the others, paying back the due late. So I think there's is sort of a caveat there. And also, the local government problem, has been around for some time now. I think the outstanding municipal local government debt is about 70 trillion yuan right now. I think, many of the local government, for example, Wuhan local government is debt load is like 500% of the government revenue intake, right? So it's particularly acute, right? So that's the probably one of the heaviest indebted local government in China right now. I think going forward, because of the central government's debt is still very low, right? So I think the central government's leverage ratio is about 30% or less than that. And so in that case, the central government can somehow do a debt swap, for example, to take on the local government debt and use the central government's credit rating to lower the borrowing costs, etc., etc. So it is a mess, but then at the same time, it's not unsolvable. The problem is not unsolvable.
Where has all the...
I see consolidated government debt in China is much higher. According to the figures put out by the IMF and JP Morgan and other people who have sufficient number of economists to study this, presumably with some degree of accuracy, at figures which are closer, on a consolidated basis, which are closer to 80 to 100%. And I think the fiscal constraints do arise in the case of trying to fudge without, real debt write-downs, local government financing debt. I think it's very difficult to make it kind of go away in another three-symbol trick, where it disappears into an asset management company. That is precisely why I think that the problem of the malfeasance of loans and assets in China is now coming home to roost in terms of a reduction in the outgoing secular rate of potential growth.
So I just want to add one thing to the fiscal side from a completely different angle, which is that many people say, well, they can, and we're not saying this morning, but just in the public at large, many people, well, they can just inject some fiscal stimulus yet again. Now, first of all, we've got the debt problems, but also I just don't think that the marginal utility of building even more roads and bridges is really going to cut it this time. I think they probably have enough of these things running around, at least in the urban side of the equation. And so I just question whether fiscal stimuli themselves, which is what they want to do a little bit, funding of infrastructure projects yet again to get the economy going this July, August, I just don't think that's going to happen.
Can I ask the three of you, where has all the credit injections gone? We've had record money supply, we've had big credit injections. I think in the month of March, total social financing was the highest for a March month on record. Where's that gone? Why has it not helped the economy?
Well, you have a breakdown.
Hang on. Let me bring Hal in first.
Breakdown in the relationship between credit and the economy. This happens very frequently. If you remember the famous phrase, I think of Milton Friedman, you can't push on a string, and monetary policy is a string. So what happens is that credit is created, but it doesn't result in output, and then you see that the credit creation and the stock of credit in relation to output is rising, which means the marginal productivity of capital is falling. And that's exactly what is happening. And I would add that the budget deficit in China, again, on a consolidated basis, is north of 13% of GDP, which is a point at which you really have to think twice before you add more to it.
How? What's your assessment?
It's very easy to explain. Well, firstly, you're seeing record lending because the size of the economy is substantially bigger than before, right? So you're talking about 120 trillion yuan worth of GDP. Therefore, naturally your loan size, your credit size has to be bigger than before. If you want to sustain 5% growth. And at the same time, what you're seeing is that, lending growth is substantially less than M2 growth. So M2 is growing at 13%, and lending is growing at about 10, 11%. So what that means is that, some of the money is being lent out and then redeposited back to the system. Right? The reason why that is the case is because you can have a higher reinvestment rate on your cash than the borrowing cost. So, companies, especially, the SOEs with means who can borrow at a very cheap cost from the banks, they borrow money from the banks and then, put it into the money market, right? So that you can earn a spread. So that's very easy money, risk-free to earn. So, even if you don't have investment opportunity, you're incentivized to do that, because you can earn a risk-free return. So that is the reason why, even though we're seeing record lending at the same time, we're seeing record deposits growth as well, because, the money is just going back to the system to be reinvested.
What would you like to see, Enzio, to put the recovery back on track? If the economy is disappointing and it's maybe over-relying on the manufacturing sector, on exports, what specific measures would you like to see?
Specifically, 3, liberalization and more liberalization of the private sector. The impression that I get in the Western press, I'll confess I don't read Chinese or speak any of the Chinese languages, but the impression one gets is that the private sector has been relegated to being a poor cousin, something to be shoved around at will by local and national government officials. And I don't think that if the private sectors, as I suggested before, actually accounts for 80% of urban employment, then I think that they really have to liberalize and allow that private sector to get going again. Indeed, as Deng Xiaoping did, that was the whole magic of what he did. Until that happens, I'm afraid these 3 rhinos, the zoological dystopian outlook is going to worsen.
David, what would you like to see?
Well, I think, of course, what I'd like to see, what I think I'm going to see are 2 different things. First of all, I completely agree with what Enzio has already said. You need to take the harness and the blinkers off the private sector. Number one. Number 2 is I'd like to see the Washington Consensus, which is really enunciated by Jake Sullivan and by Yellen, which is really the way which the US is going to, and its allies, by the way, are going to deal with China, which is you'll get nothing on technology which can be put to a dual use in defense or directly into defense without dual use. We'll trade with you provided you're obeying our concepts of the free market, and we'll join with you if you're combating a global threat like climate change or epidemics. I'd like to see that reversed because both sides agree to play by the same rule book. And thirdly, I think there's only one way to write down a bad debts problem, a legacy problem in society, and that's to write down the assets and it's to write down the loans and clean the shop. That's the only way you can get the system to function properly. I think the current regime in China, the current administration in China, will put the political aims of a rising China ahead of achieving any of those particular goals. So I don't expect my dream list to come true.
Okay, thank you. Hal, what would you like to see to put the economy back on track?
Well, It's very easy. Just do a consumption coupon, like the Western countries do. Yeah, it's very, very easy.
So they should speak to Paul Chan.
It's a big round of national wealth transfer, from the central government to households. Just now, one of the guests mentioned that the households are somehow undercompensated for the labor, and also the household sector, as a percentage of total economy is very, very low. In fact, the household sector in China as a percentage of economy is the lowest in the world, right? Comparing to the other countries, right? So then that way, it's the key reason why the households can't spend, because they just don't have enough means and income, and right now the situation is being exacerbated, by economic difficulties and also the prior pandemic. So right now, what you can do as a central government is that you distribute consumption coupon, but then at the same time, the central bank can print money and buy the new debt that is being issued by the treasuries. Then that way, I think China is in a perfect position to do this, because inflation in China is like almost zero, right? So you don't have an inflation boundary like the Western countries do. And I think, the consumption coupon idea worked exceedingly well in the past 3 years during the pandemic in the developed countries. And I think we can do the same in China.
Do you agree, Enzio? Consumption vouchers?
I think that might be a good one. But again, I get back to my liberalization stuff. And I think also what both gentlemen have said, the other measures are very useful. I just wanted to warn that either have this, if they don't do things that we've suggested, the three of us this morning, it will either become a Rhino or a Japan that's been on its back since 1990. In other words, for the last 30 years, only now do we see some wages growth coming through, and that's beginning to, I believe at least, help the Japanese economy get back on its feet. So I think those are the challenges that China has to really face head on. And I just hope that pragmatism will prevail.
Well, let me turn our attention to the markets. Hao, I think it's fair to say, isn't it, that May has been an absolutely miserable month for Chinese stocks, both for the Hang Seng and the mainland China markets. They're at their lowest levels of the year, virtually. The Hang Seng China Enterprises Index slipped into a bear market for a while yesterday. The Hang Seng is not far off of it. It's down about 18% from its high. Hao, first of all, what's gone wrong?
Yeah, well, I think, Peter, last time when we talked, we mentioned about, how the Hang Seng Index is running into resistance, and I don't see any further upside from 23,000 level, and now we're at 18,000, right? So it's a market correction that is still ongoing, and unless we see some stimulus or some sort of policy actions, from the top, it will be very difficult to move because, economic data will continue to somehow meeting expectation or disappoint. And the other factors that can move the market is not improving either. Right. So I think, one thing the government can do is, to provide or to rebuild confidence through the stimulus program. But I think, normally, a large-scale stimulus takes time to discuss. And also, you have to influence the public opinion as well. And seasonality-wise, May and June, has been particularly bad months for the Hang Seng, right? So that is the reason why, I think people just given up and probably, taking some time off for the summer.
Foreigners in particular seem to have given up, don't they? They seem to have bailed out of the markets.
Yeah, just go out and go fishing and come back in September maybe.
So, I mean, you predicted the rally very well that we saw into the beginning of this year and called it very close to the top of the rally. Where would you be now, given where the markets are? Do you think the bad news is now fully priced in? And would you be neutral, overweight, underweight on Chinese stocks? What would you do?
Yeah, I think right now, because when I forecasted the rally back in late October last year, I had a 23,000 price target on Hang Seng, and Hang Seng get to like 22,800 ish. So it's like within a striking distance of my price target. So right now I am basically being neutral, because after all 18,000 is very cheap. But then at the same time, cheap is not the reason to buy, because you still need a catalyst, for the stock to move. And right now, we're just not seeing, a obvious catalyst right now.
Mm. David, foreigners in particular, they seem to be particularly concerned by the geopolitical tensions. They're disappointed at the lack of stimulus. The economic news just hasn't really been very favourable to them. Do you get the impression that?
Well, look, we have no recommended investments in China, and actually I haven't had since I last spoke to you on this in your former life. So that hasn't changed really. Markets can go up and they can ignore structural problems if there's enough liquidity and greed driving them. But when you hear the conversation of all of us this morning, it's clear that we're not geniuses outside the range of what the market is worried about. We mirror it. We re-articulate it. But the market now has got everything we talked about in its focus. And therefore, it will not go up until there is, I think, either clear resolution of the structural problems, the rhinos,
yes,
and the international problems.
Absolutely.
If they don't see that, then because it is in focus, it won't go up. And I would add just one other thing to that, which is, I think it was Enzio said that there's concern that the private sector is not in the position it once was in China, is being pushed around. So if you take common prosperity, the feeling among foreign investors is very much that we don't actually know what our rights are in investing in the private sector in China. They can change rapidly. We can wake up in the morning and our long-term dividend discount cash flow has lost about 50 years. So that the company is worth much, much less than what we thought we could see with some clarity yesterday. And I think that question mark over how the private sector fits into the restructuring of China, the reforms we've talked about, and indeed even the current market outlook, I think that is a major concern for foreigners.
Yes.
Enzio, do you agree with that?
Yeah, I don't, maybe it's because of my von Hayek training, but I just think that it's this private sector. The consumption voucher will be a great one-off idea, but we see with dear old Paul Chan here that he keeps on having to inject ever more consumption vouchers to get the goat going. So I think it is more of a structural issue. And again, I would also warn that if they start beating up on the foreign multinationals in China, then they will lose even more on technology. We all know that growth is a function of technology, technological progress, productivity basically, and demographic growth. And so with demographic growth going down, I think that this factor productivity has to rise quite considerably, and those are really the challenges that need to be addressed. I just think that if you don't have to be in China, there's really no reason even for just a private investor to really put their money there. I mean, you do have more interesting stories around. I mean, a few of them, obviously we know that what I call the global economic time is not great. Guess what? The Fed rates will probably keep on rising for a while still, in my humble opinion, up to about 6%. That's not going to do markets any good anyway. But there are still pockets of growth and fabulous companies in very capitalist America, for instance, that are doing just well. We just listened to Warren Buffett, what he's doing.
Mm-hmm. How I think it's fair to say, isn't it, that enhancing shareholder value is not a priority for the Chinese government, and certainly not returning profits to investors either through dividends is a priority. And you've got other markets in the region where that is, yes. like Japan. How big a problem is that?
I'm not entirely sure. Like, what is the sort of enhancing shareholders' value? I mean, because after all, a healthy and growing stock market is still yielding the benefit of China, right? So, firstly, you still need to finance the growth, and secondly, I think a buoyant stock market actually instill confidence in the population, right? So I think it's actually quite important, to have a healthy, growing stock market. And so I think, right now, so far this year, one theme or the few investment themes has been doing particularly well in the domestic Asia market, which is the AI sectors, semiconductor sectors, and also the SOE sectors. These stocks have been flying, really. So I think right now, the problem is that, because the economy is slowing and people are not sure what to do just yet, especially they're not sure what kind of policy is going to get, from the central government, and people were just adopting a wait-and-see approach. All right, so I think, right now, because the market has slowed down so fast, almost 20% now, and maybe there's a little bit further downside to go, but then it is not the sort of a time to be overly pessimistic.
Do you think that euphoria in the AI sector will continue? I mean, we know pretty well overseas certainly what stocks to look at. It's the Nvidias, the Taiwan semiconductors, and they've, particularly the Nvidias, they've just gone through the moon. Is this a phase, or is this something real here? Is there a real transformation going on now in the technology sector that AI is going to spur, and that's going to really drive these stocks further?
Yeah, I think many people would refuse to believe that the AI could go much further from here. I think for in the near term, it's poised for a pause. Because Nvidia, the leading stock in the AI sector, has been going tremendously well. So I think it's bound to run into resistance because it's trading at about 25 times price to sales. So I think Nvidia is a signpost for the domestic AI stocks as well. So if Nvidia take a pause, then I think the domestic sectors could take a pause as well. But I think in the long term, though, AI is definitely one of the growth engine, right? So I think Tony Ma of Tencent and also Jensen Huang of Nvidia, they all say that AI is similar to a new growth in a computing industry, right? So I think for the longer term, for secular growth, you still have to position in this sector.
David, we've got about 2 minutes left. Are you convinced by this euphoria that we're seeing in AI?
By the technological change and by my view, which is that large language models, instead of putting everybody out of work, will make relatively mediocre people more clever by giving them tools that they could never have mastered otherwise, like programming, answering questions, writing essays, and so on. So I think you then move on to quantum computing, which is the way that AI will really work when it works. And that's all fine. I think the stock market is a bubble, but I don't think what's happening in the actual technology is a bubble. I think that is it's going to be a lift-off process, but it's very exciting. But would I plunge into the AI stocks now? Certainly not.
Well, thank you all very much for your thoughts this morning. Great to hear you. You heard there David Roche, who is President and Global Strategist at Independent Strategy, Hao Hong, who's Chief Economist at Grow Investment Group, and our regular Wednesday commentator, Enzio von Pfeil, who is a capital preservation specialist for individuals. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and Hong Kong-based macro strategist Patrick Bennett. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Have a great day.
Money Talk